Last night, the most valuable company on earth reported the biggest quarter in its history, $96 billion of revenue, up 106% from a year ago. A 75% gross margin, which is a number software companies dream about and hardware companies basically never see. And then it did something it has never done in 33 years of existence. It guided a full year ahead. 70% growth for fiscal 2028 against a Wall Street that was modeling 44. The stock went up 7%, and the argument about whether artificial intelligence is a bubble got declared over again. I want to show you a different page of the same document. Here's what everyone read. Revenue beat. Data center revenue, $89 billion, up 117%. Earnings per share, $2.46. Next quarter guided to $108 billion against a street looking for $104. And the backlog, which management put at more than $2 trillion. $2 trillion. That is a number so large it stops meaning anything, which is exactly why it made every headline. Every single one of those figures is real, and I'm not going to argue with any of them. But an income statement tells you what a company earned. It does not tell you what a company collected. Those are different questions, and this quarter they have very different answers. Park those two numbers, because they're the ones that moved the stock. $108 billion of revenue guided for the current quarter, plus or minus 2%, and 70% revenue growth guided for the full fiscal year after this one. That second number implies something close to $700 billion of annual revenue, which would put this company behind exactly one other American technology business by size. And there's a detail inside the guide that makes it more impressive, not less. It assumes zero data center compute revenue from China. Zero. The second largest market on Earth is modeled at nothing, and the number is still that big. Except here's the page nobody put on a thumbnail. Net income for the quarter, $59.7 billion. Free cash flow for the same quarter, $21.3 billion. And the quarter before this one, free cash flow was $48.6 billion. So revenue went up 18% from one quarter to the next, and the cash the business actually generated went down 56%. Not down a little. Down by more than half. On rising sales, at a company with a 75% gross margin. That is not a rounding difference, and it is not a seasonal quirk. Something in the shape of this business changed, and the filing tells you exactly what. Quick backstory, because this is the whole video and I don't want anybody lost. Profit and cash are not the same thing. When a company ships a product, it books the revenue and the profit right away, even if the customer hasn't paid yet. The unpaid amount sits on the balance sheet in a line called accounts receivable. That's just a formal phrase for invoices sent, money not arrived. Free cash flow is the other measure. It's what actually landed in the bank after paying for everything. There's an old line in accounting. Profit is an opinion, cash is a fact. The gap between the two is usually small and boring. When it suddenly gets very large, it is telling you something about who is paying and when. Here's the line item. At the end of the last fiscal year, in January, this company was owed $38.5 billion by its customers. 6 months later, on the 26th of July, it was owed $63.1 billion, and $22.3 billion of that build happened in the single quarter. That figure isn't my calculation, by the way. It sits in the company's own cash flow statement as one of the reasons cash generation fell. On a quarter that did $96 billion of revenue, $63 billion of unpaid invoices is roughly 60 days of sales that have been recognized but not received. Meanwhile, inventories climbed from $21.4 billion to $31.6. The chips are moving. The money is moving slower. Why is this happening? Because the business has quietly changed jobs. Look at what else is in this filing. On the supply side, the company has locked in about $279 billion of supply commitments, most of it memory for its next-generation platform. That is money promised to suppliers before a single customer has paid. On the customer side, it announced partnerships with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to, in the filing's own words, mobilize over $500 billion of third-party capital for the build-out of artificial intelligence infrastructure. And on the balance sheet, non-marketable securities went from $22.3 billion to $51.2 billion in 6 months. That's equity stakes. In the ecosystem, that buys the chips. Add those three together and you are not looking at a component supplier anymore. You are looking at something much closer to a lender, with a factory attached. Now the kicker, which is 3 facts stacked on top of each other. Fact 1. In this quarter, a company generating $59.7 billion of net income borrowed $24.9 billion. Long-term debt went from $7.5 billion to $32.4 billion. Fact 2. In that same quarter, it spent $19.7 billion buying back its own stock and another $6 billion on dividends. It borrowed roughly what it returned. Fact 3, and this is the one that made me sit up. Of that $59.7 billion of reported net income, $7.77 billion came from gains on equity securities, marking up the value of stakes it holds in other companies. Roughly 13% of the headline profit did not come from selling a chip. It came from the rising valuations of the businesses buying the chips. One more tell, and it's small, but it points the same direction. This quarter, the gross margin was 75.0%. Next quarter, the company's own guide is 74.0%. That's a full point lower, guided by the business itself. The reason is memory. The three manufacturers who make essentially all of the world's memory chips have shifted capacity toward the high bandwidth kind that artificial intelligence accelerators need, because it earns them far more per wafer, which means the single largest input cost in the product is also the scarcest thing on Earth right now. So think about what you actually have. The company with more pricing power than anyone in technology just told you its margin is going down, its receivables are going up, and its cash conversion has halved. All in the same document that made everybody cheer. Now the honest part, because a story this clean deserves to be attacked. 4 ways this read could be wrong. 1. Receivables always lag a step change in revenue. When sales double in a year, the amount owed to you mechanically builds, and there is nothing sinister in that arithmetic at all. 2. Roughly 60 days of sales outstanding is a completely normal collection period for enterprise hardware. On its own, it is not a red flag. 3. Borrowing $25 billion while holding enormous cash can be pure treasury management. Locking in terms, funding buybacks efficiently. Plenty of very healthy companies do exactly that. And 4. Those equity gains are fully disclosed, and the company strips them out of its own adjusted figures. Nobody is hiding anything. I found all of this in a public document in about 10 minutes. Hold all 4 of those. They are the strongest case against everything I just said. And if you only remember one thing from this video, it should probably be that the numbers are facts, and the interpretation is mine. Here's the read, and then a call you can grade me on. The read. The demand is real. I am not disputing the demand, and I don't think anyone serious should. What has changed is where the risk lies. When a vendor pre-commits $279 billion of supply, extends $63 billion of credit, takes $51 billion of equity in its own customers, and helps arrange $500 billion of outside capital for them, question it is exposed to stops being will they want it, and becomes can they pay? And listen to how management framed the 70%. The chief executive said the company has supply for 70% growth, and that demand is much greater than 70. The chief financial officer called the figure supply constrained. Read that literally. That is not a forecast of what customers will buy. It is a disclosure of what the factories can build. Those two things fail in completely different ways. Now the call, dated today, the 27th of August, 2026. When this company reports its October quarter, sometime in late November, free cash flow will again come in below half of its reported net income, and accounts receivable will be above $70 billion. If both of those are wrong, my read is wrong, and I will say so on the day. Market spent last night arguing about whether $108 billion was enough. It never got around to the more interesting question, which is who writes the check. In November, skip the headline. Open the cash flow statement first. Research and education only, never personalized advice, and every number in this video is sourced in today's written issue. There's also a full daily brief covering the rest of the tape. I'm Frankie, the asymmetric signal. One Contra Ryan read a day, subscribe.